Hello and good morning, listeners. Welcome back to Almus Market Mornings, your guide to financial market developments with Jayaram Krishnamurthy. Now, this and the next week has a lot in store for the financial market participants, along with the actual fireworks outside. So, we have the data and the event based fireworks scheduled as well in the next 15 days. And JK, we have the GDP data for US and Europe, inflation update tomorrow, and the unemployment update this Friday. Even yesterday's Jolt's opening gives the hints of a weaker job market for the US. And the next week's election and the FOMC are again another bit to consume. So there's too much to consume from the financial markets point of view. What do you think participants should be taking out from these kind of updates?
Good morning, Shikhar. Actually, market has been so much overwhelmed by the election, the tariff, the Trump trade, etc. That people have kind of ignored the economic data that's coming through. And yesterday was one busy day relatively on data, both from Europe and US. And on the US side, there was some mixed data. In fact, I would say there was kind of what to choose, whether hard data or forward-looking survey, because the job openings, as per the Jobs data, fell to its lowest level since 2021, and layoffs picked up, and also job quits were much lesser, which means people are finding it difficult to get an alternate jobs. So the available position decreased to 7.44 million from a downwardly revised 7.86 million in August. In fact, the job openings have been on a downward trend for the last 2 years, and this report showed vacancies declined broadly across the industries. Openings to the ratio of job vacancies to available workers below 1.1. In mid 2022, the number was 2:1. At the same time, the consumer confidence, as per the conference board, actually shot up quite a bit, to 108.7 from 99.2. And the assessment of current business and labor market conditions increased as per the data. All the 5 components of the index also improved. But in the overall assessment, if you look at another forward-looking indicator, just that was released a week back, the leading economic indicators had seen quite a fall actually, and it has been falling in the last 3 months quite a bit. So you really have to choose between whether the hard data that is coming through and particularly the consumer confidence survey, which may be kind of subjective. In fact, we had another hard number, that was the US trade balance. The deficit widened sharply to 108.2 billion from 94.2 billion as per advanced estimates. Imports increased, and there was a fall in exports. This also gives rise to expectation that the net export will depress the GDP number going forward. In fact, Atlanta Fed's estimate of GDP for Q3 is now revised down from 3.3 to 2.8. So this kind of underwhelming news from US, I would say, and with markets already having discounted quite a bit of Trump victory and the resultant tariffs, etc. I think there was some correction due, and that is seen happening. And also correction could also come because we have seen more better news from Germany yesterday. The GfK consumer confidence improved to minus 18.5, and though it still stays in negative territory, it's actually an improvement of over 2 points compared to previous month. This is coming, closely after the EFO business sentiment recorded higher earlier this week. So a lot of focus is on Germany because there's been so much of depressing news. The GDP number for Q3 first estimate is likely to come minus 0.1, putting the country in another technical recession. We'll have a host of GDP numbers from various nations in Eurozone, including the Eurozone itself, and the German inflation number, which is expected to slightly come higher. But none of this is likely to move the ECB away from 0.25% rate cut when they meet next month, and 0.5% is still on the debate. I think a lot depends on how upcoming economic data prints from Europe. So overall, there is no tendency for some kind of profit taking on the Trump trades that we have seen. Bond yields have dropped in US by about 78 basis points to 10-year tenor, and people are now looking at whether they have already discounted the possible outcome of the election in terms of Trump victory, and maybe if the result is otherwise, maybe they may be caught on the wrong foot. So that's one thing that is likely. So the dollar also has slightly moved away from its best levels once again. Euro making some sort of a recovery, but all of them stay in a range, and perhaps the month-end flows will determine in the next 2 days how we move until the US non-farm payroll data, and then we wait for election and FOMC next week. A host of data, yes, starting today, ADP, tomorrow the job cuts, weekly jobless claims, all that also precede these important events, no doubt. On the rupee, nothing much home to write about in terms of intraday movements. We are still in the same less than 1 paisa range for the days, but then significantly the FI outflows, which have been determining the rupee's move of late, has actually tapered off a bit in the last few days, and we wait and see whether the FIs have finished some amount of exit, and then possibly they also wait for outcome of US elections and the FOMC meeting. That we'll have to wait and see, but definitely maybe some relief for the buying pressure from rupee for the dollar rupee as well. And the oil prices, no doubt, is also a support for the rupee to not to weaken too much from here. I think the next 2 days, the nature of outflows or inflows will actually determine whether we make some sort of a move in the rupee or we stay in the same range determined by RBI. Yeah, I think we sit back and wait for all these big events to go through, and then we'll take a call on the next directional move on the currencies. Thank you.
Okay, JK, and yes, folks, dollar rupee has remained extremely narrow in its range, and even though the one of the influencing factors of FII outflows have now taken some sort of a breather, but it needs to be seen over time whether it was just a temporary pause or things are reversing for the good. On the other hand, we also have some sort of a support from the oil prices for the Indian rupee, but overall, it is the international factors or the major economy factors which are kind of influencing the markets even more. As JK mentioned at the start, layoffs have been picking up, jobs opening was on the lower side, but interestingly, it was the consumer confidence which had shot up significantly higher. Likewise, the leading economic indicator continues to have a fall, which is kind of an indicator for the recession, but it's been there for over a couple of years now, and we are still we are not seeing any sort of recession yet. So kind of mixed set of data inputs for one to chew on, which is also making it difficult as to which one to really work with. And if we talk about the kind of recoveries or the macro updates, as JK mentioned, we've seen some sort of recovery on the euro front, and this kind of recovery can make the limited movement for the DXY strength for the time being if the recovery continues. Again, as JK mentioned, the ECB is quite likely to go ahead with the 25 basis cut, so there's not much change in the stance front. But overall, it looks like the market participants have started discounting the Trump trade well, and now they are looking to take a different set of actions. So that's where we leave the today's update. Having said that, folks, we wish you all a very happy Diwali with the market-related fireworks ongoing. We hope you have a lot of other good fireworks in your life, a good set of news, updates, prosperity for you is in the coming. So, from Almus, we wish all of you all a very happy Diwali and a prosperous New Year. Thank you so much for listening, and we shall come back again tomorrow with another round of updates. Thank you.